Good morning. First and foremost, I hope everyone is staying safe and healthy. Thank you for joining us today to discuss the impact of COVID-19 on the retail supply chains. My name is Poonam Goyal, and I am Bloomberg Intelligence's Senior Retail Analyst covering athletic department specialty and off-price retailers. Some administrative rules before we get started. Today's presentation will be recorded and available for playback. You can access it via the link sent to you by Bloomberg Webinars. At the bottom of the slide window, you can adjust the volume and maximize your screen. Please feel free to ask a question during the presentation by submitting one to the right of the slides. With that, a quick overview on BI for those who aren't familiar with it. Bloomberg Intelligence, or BI, is Bloomberg's in-house research arm, providing a new way for our clients to access company and industry analysis and data, all at our fingertips via the terminal. BI provides company, industry, credit, regulatory, litigation, and economic research to Bloomberg's more than 330,000 customers around the globe. Currently, we have over 1,800 companies under coverage, and with 135 plus industries in North America, Asia, and Europe, driven by BI's 280 independent analysts. In addition to the research, BI also curates a large array of data sets related to each sector that users can turn into actionable information. For example, many of you may have used the spend trend and Prodco data sets to gauge spending and traffic patterns. With that, it is my pleasure to have with us here Ronen Lazar, CEO and co-founder of Intern, Arnold Kogan, partner at Boston Consulting Group, and Edward Kenney, SVP and Global Head of Consumer Products and Agriculture Business at SAP. So let's get started. And with that, I'd like to turn it to first Ronen to talk a little bit about his role at Intern, and if he can quickly start out by talking about the consumer space and how do we see things different between the essential consumer goods and the non-essential spaces like fashion. Ronen, if you could talk about how consumers are responding there and what you see in your role at Intern.
Well, good morning, everyone. Thank you for having me here. Just as a matter of background, Intern is the only enterprise solution to provide a system of record for optimizing slow-moving or excess inventory. And our approach is that by streamlining the workflows, our platform enables brands and retailers to improve margins, gain efficiencies, and recover cash faster, all while ensuring channel protection. So with regards to the consumer space, we're seeing two very different perspectives in fashion and say CPG. And what's interesting is what happened before COVID and what we're really seeing now. Before COVID in fashion, we were seeing problems in the industry stemming from just a lot of commoditized goods on the market, change in consumer spending, extreme pricing pressure surrounding discounts, and dwindling foot traffic. That was compounded with just a lag of innovation and not a lot of use of retail, just data. And so due to the seasonal cadence, there's right now a massive supply. We're seeing spending down nearly 70% from pre-COVID times. Within that, you'll see fast fashion is faring quite poorly with roughly 90% reduction, and luxury, from the data we've seen recently, has over $125 billion of unsold inventory for the quarter. And so the theme that we see is that the more the mainstream the brand, the better they're doing. And those with strong e-commerce infrastructure are doing significantly better, although have still taken a massive hit. The real challenge isn't about the supply disruption, it's really with demand. And even as we get back to normal, please God soon, demand will be low, and this will lead to what some are calling the biggest liquidation sale in history. Sadly, we might also see numerous bankruptcies, and we're seeing some of that pop up in the news. On the CPG front, quite a different perspective. In general, accurate demand forecasting and effective demand planning has been a challenge. Roughly a year ago, retailers started pulling back on replenishment inventory, and some had reduced inventory on hand by up to 25%, depending on the category, in an effort to operate in a more optimal manner. So with this newfound agility, CPG companies, which typically sell fast-moving consumer goods, started ordering more inventory more often and in smaller quantities, requiring the manufacturers carry replenishment to deliver in a fraction of the lead time. This led to unpredictability on what to have, where, when, and for who. And in the past year, in some cases, we've seen increasing slow-moving and obsolete good levels by 50% year over year, ultimately leading to a lot of waste. In this environment of COVID-19, with the fear that the world is in danger and in recession, we've seen grocery stores and supermarkets show some strong resiliency. And in part, it's due to the fact that spending on groceries in general, is roughly just under $8,000 a year per family, and a large portion of that is spent outside the house, nearly 50%. And here, despite a 15% reduction in daily spend, consumers are spending substantially more on fresh food, household cleaning products, personal care, and of course, packaged food and beverage. The real concern here is when you have such high level of volatility in demand, there's a risk of there being distortion up and down the supply chain. What's interesting, I would say, for the CPG world is unlike in fashion, where companies are struggling to see where to sell their goods, in CPG, we're seeing companies double down, not just on replenishment inventory, but actually achieving their sustainability plans, which they had planned for before COVID-19 hit.
Thanks, Ronan. And Arnold, if you can tell us a little bit about, what you're seeing from your end and your role at BCG.
Great. Thank you, Poonam. Well, good morning, everyone. I'm Arnold Kogan. I'm a partner out of the New York office with BCG. And just to give you a little bit of my background, I have roughly 15 years of experience helping retailers and CPGs drive growth, cut costs, and optimize cash conversion. Most of my work has been transformational in helping consumer companies optimize their capabilities, really across the full value chain, starting from product design all the way through last mile delivery. And I've worked with a number of companies across a multitude of categories, ranging from center store categories like beverage and snacks, perimeter store categories like meat and cheese, and also fashion and luxury and consumer durables. So in terms of the trends, and as we all know, and as Ronan just mentioned, we've seen a spike in sales due to the panic, which has led to stockpiling. We've also seen a volume shift from out-of-home to in-home. And when you double-click into that, what we see is that, and we all see this, CPG sales are now shifted to the essentials being the food, the beverage, the household staples. And what we're seeing is that consumer spending on those paper goods and packaged foods still remain quite high. Just to give you some numbers, when you look at the last week of March and compare that to the previous year, same week, you see that paper products are up by roughly 41% in the U.S. And if you look at that same time period, you'll see that frozen food is also up by 30%. On the other hand, what's interesting is if you look at categories that are non-essentials, take toys, for example, you see that demand down. Now, some of the other trends we're seeing is a boost in e-commerce sales. Ronan, you mentioned this as well, roughly 40% in new online shoppers. And we also see that there's been pressure from private label and value pressure put on brands. And when you summarize all of these trends, what this has caused, it's an extreme level of demand volatility and unpredictability. And it's making it very, very difficult, not only for the retailers, the grocery retailers, but also the CPG manufacturers to respond. And what I've seen so far on the CPG side is that companies have responded in a number of ways. Most of them have stood up a central management office, a centralized team that's focused on rapid response with clear decision rights. What am I going to do in crisis? Who's going to do what? How do I react? So that's number one. The second thing that they've done in pockets, I wouldn't say in a very integrated way, but in sort of pockets. They've built tools to monitor key risks. Some of these are visualization tools to monitor, hey, what if my demand spikes or what if my demand goes down? What are the potential supply situations? What are my constraints? How do I react? And they've instilled that dashboard, that visual, on a daily basis to monitor and respond. I would say the third thing that they've done, both CPGs, is they've taken a look at their network. They've looked at their manufacturing plants, their contract manufacturers, also the distribution side of things, their 3PLs, and try to understand, how do I maximize my output among that physical flow of assets? And they've done things along the lines of, how do I increase my production line efficiency by eliminating unnecessary maintenance on the line so I can get maximum throughput? How do I qualify new contract manufacturers so I have additional capacity for highly demanded essentials? Or answering the question around, how do I have more warehousing capacity and throughput to meet my retailer and my consumer needs? And I think the last thing that they've done quite well is on the direct material supply and identifying who are my risk suppliers and predicting out material shortages. And the other thing that's interesting, and this is most recent, is that some companies have also responded by taking it to the next level, beyond these baseline things. And by doing that, we've seen a number of spirit alcohol companies taking their excess capacity and repurposing assets to make things like sanitizer, for example. We've seen food companies simplify their product portfolio, work with retailers, simplify the SKU mix away from tail brands. And what you end up doing when you do that is the food companies have also seen efficiency. By having a smaller assortment of products, they're able to run their lines more effectively and efficiently and really maximize their throughput. And Poonam, to your last question, in terms of delivery and fulfillment, what we're seeing now, and we foresee this being a very hot topic in the coming months, is companies starting to rethink on a more strategic level what their distribution network needs to look like to enable e-commerce D2C fulfillment. And they're specifically trying to understand right now, what are the number of locations do we need to have, and how close in proximity do we have to be to our consumers? Other questions that come to mind is, should we leverage 3PLs who are proven, companies like Radial who have a strong e-commerce capability? Do we use them to scale that new capability in e-com? And then the last thing they're looking at is warehouse automations. Where do we invest? Do we invest in put-aways, sortation, pick automations, with the intent of understanding, where do I build speed and flexibility? Where do I selectively build speed and flexibility to manage this extreme volatility?
Great. No, that helps. And that actually is a good segue into, EJ's role at SAP. EJ, if you can talk about just what you're seeing in terms of delivery and fulfillment and the different trends that we're seeing today, and talk a little bit about how SAP kind of helps solve those problems.
Sure thing. Thank you very much. My name is EJ Kenney. I'm responsible for the consumer products, and that includes fashion, food, beverage, health, personal care, and even also agriculture. So it's pretty broad, we say, from Cargill to Armani from a product perspective. And it's really remarkable when we look at the COVID-19 crisis. It's impacted all of those product segments, but it's impacted them very differently. I think probably the hardest hit one is certainly the fashion and luxury segment, where we've seen entire season collections being canceled. The amount of retail, especially those large fashion brands that have a significant retail presence, and the retail presence being closed. There's excessive in-process fabric and in-process materials that haven't been converted, or they have been converted and they're sitting on ships. They've also had significant employee reductions as well, and has had significant impact on various communities, especially communities we may not be thinking about in terms of Bangladesh, Vietnam, and China. When we look at the health personal care, as was mentioned before, there's been a rebalancing of capacity in terms of Procter & Gamble getting into antibacterials. There's been looking at manufacturing capacity and supply chains and trying to rebalance them in order to meet these spike needs. It's putting a lot of supply chain pressure on transportation, warehousing, and also it really puts a premium on companies that have agility and resilience built into their supply chains, because they can bring on new suppliers, new contract manufacturers, co-packers, and be able to meet this enormous spike demand. When we look at food and beverage, we always think about, I think, kind of the retail side of it. However, most large food and beverage companies also have a food service component that went dark overnight. So they have these enormous capacities and plant capabilities that are designed to produce products for education, institution, hospitality that went dark overnight. So they're quickly trying to retrofit, ship packaging, and also look at other ways to help respond. And what's been in the news here recently on the agriculture side, because of this food service segment going dark, you're finding dairy farmers dumping milk because they don't have the processing capacity downstream to put it in what was traditionally into education and hospitality segments, as well as we're coming up to agricultural seasons that require contingent labor. And 93% of the world is living in countries that have had restrictions on any kind of people coming in, and so how are those contingent labor forces going to help satisfy? So there's some great and significant challenges, but the challenges are very, very different depending upon the sub-industry. I think the unifying principle across this, though, is companies are really looking for how they can build greater resiliency in their supply chain and much greater business agility, and also clean up their balance sheet and look for cash flow improvements.
EJ?
Yes, Poonam?
Hi. Did I lose the conference? Hello?
Yep. No, I can hear you.
Okay, perfect. I'm sorry about that.
Did you hear?
Great, thank you.
Okay, I'm not. Okay, hopefully that answered your question.
Yes, that did. Thank you so much. And I just want, I would like Arnold to kind of follow up on that. If you can talk about this external volatility and if it's here to stay, given what we're seeing in the supply chains and just with the demand shifting, what do you think, Arnold, companies can implement to limit the damage and just to be better prepared as they deal with what's happening not just today, but also the recovery and what that would look like?
Yeah. No, good question. In terms of resilience and really being better prepared for the next situation as we get into recovery, I mean, there's a number of things companies can do. One of the first things companies should be looking at is taking a hard look at, what is my commercial strategy given the shifts? What are my key business requirements in terms of customers, my channels, my categories, and my geographies? And then really translating that into what is the associated flexibility and agility that I need in my supply network to meet those requirements. So it's really thinking through that strategically. And that might mean, having excess capacity, having product that's manufactured locally or sourced locally. And it could come at a price, at a higher cost, which could eat into the margins. But those decisions and trade-offs need to be made. I think the second thing is around capabilities and looking at what are the priority capabilities do I need to have to enable resilience. And those could be capabilities around speed, where I have to relook at my ideation to launch process maybe historically it took me 6 months or 4 months to launch a new product from concept to final launch. How can I speed that up in times of crisis so that I can launch a product in the marketplace very quickly to meet demand? Or it might mean, how do I rethink my demand planning and how I forecast demand? We now know, if you look at companies responding, their traditional demand sensing and their sales and operations planning processes are somewhat ineffective because they've looked at historical demand, and now demand is so volatile, the algorithms are not necessarily working on across all their categories. So, really thinking through, how do I use external data? How do I apply artificial intelligence and machine learning to better sense demand so I can fulfill that? I think a fourth thing, and I brought this up earlier, Poonam, to your question, is around automation. Companies have looked at selective automation now in the response stage, but I think, moving forward as we get into recovery and thinking about the future, it's really looking at automation across the full value chain. For example, in manufacturing, thinking through, as before you might have not invested in it because it didn't necessarily have the ROI to meet the hurdle rate you had, but now taking a harder look at material movement, inline inspection of quality, and other automation capabilities that will rely less on labor and maximize efficiency. And the same thing could be said with distribution, taking a better look at it and seeing, where do I invest? But I do caution one area in that, making sure that you invest in automation, but not limit yourself in terms of flexibility, because there tends to be a trade-off between, the amount of automation you build in and the amount of agility that you actually have. And I would say the last thing, which is, probably one of the most important among these 4 or 5, is leveraging digital, not only from a visibility perspective or transparency perspective, but also the analytics to go ahead and orchestrate that. One piece is obviously the visibility, and that gives you the increased awareness. It gives you real-time transparency into what's going on in your supply chain and what's going on with your suppliers. And putting in a control tower, we're seeing some companies do that now. But taking it to the next level means now looking at simulation, putting in a digital twin, which is fundamentally a replica of your physical supply chain digitally, empowering that with artificial intelligence to make optimal decisions. And then I would say the next piece is using scenario modeling, also powered by artificial intelligence, to understand, hey, what if there is a change in demand, or what if there is some variable that shifts? What do I have to do, and how will it impact my ability to supply, my total delivered cost, my gross margins, my working capital position, and do that in a real-time way and have that capability ready to go in case of a new crisis. And I would just maybe finish off with another piece related to the digital component, which is on-demand sensing, and really thinking hard about the algorithms, looking at driver inputs, things like, external events, pricing, and so on, and seeing how that could potentially impact lift in store or e-commerce direct to consumer, and applying kind of machine learning to go ahead and do that. So just in summary, I think there's the 4 elements. It's the business requirements and making sure you set up your physical supply chain and product flow to enable those business requirements. There's prioritizing, not boiling the ocean, but prioritizing the right process capabilities that you want to revamp. The third one is automation. The last one is really putting together a digital ecosystem that cuts across your value chain and also your third-party vendors and your customers to give you the visibility and to do advanced analytics to better sense the future.
Yeah, I couldn't agree with you on that more, though. The challenge that we've seen with a lot of apparel retailers is just the long lead times that they have, which is why we've seen inventory come out of balance quite a lot over the last decade. And I think, Ronan, here's where you can talk a little bit about, just with COVID-19 and even before that, there's been a lot of excess inventory in the system, and we probably expect a lot more coming out of COVID. So in your world, how are you seeing that impact orders today? How much is actually being stalled versus delayed versus canceled? And then what retailers, if you can talk about it, are at most at risk from piling inventory? And how do we expect this inventory to be cleared? I guess it depends on, when we come out of COVID, but will much of it just be out of fashion, out of season, and what will the suppliers, the retailers do with it?
Yeah, all great questions. First and foremost, fashion is a known late adopter of technology. So in general, Arnold was talking about, digital applications. Really, the entire way that business is done needs an overhaul. Many in the business are self-described merchants with the nodes for the business, but that time has passed. And the need for a differentiated product, the need to really apply technology solutions to guide and really understand what the data represents, is absolutely key. In terms of what we're seeing, there's literally hundreds of billions of dollars of excess inventory product. It's kind of scattered throughout the supply chain, and for good reason. At every level and every phase of development up and down the supply chain, there's been some real disruption. In terms of what's been stalled, what's been delayed in the process. Thankfully, some brands and retailers have really stepped up to the plate, and they've committed to pay in full for all orders already in production or completed. And as a result, reducing harm to their suppliers, and their workers. Unfortunately, there are others who, either out of desperation or otherwise, just made the decision to just cancel orders, and the ripple effect is such that, it extends not just for today, but, for some time to come across, the entire supply chain. One of the big challenges that we see is, a lot of people talk about excess inventory and finished goods. But there's actually a big challenge today in raw materials and components, right? And the question is, what's really about to come in the second half? In terms of inventory piling up, there's been a lot of discussion of like who's holding the bag and who's the most exposed to this situation. In general, I think we're going to see inventory build last longest at the brand level for a couple reasons. One is that, they have the most difficult time canceling orders with the various suppliers they have all over the world, whom they have long-term relationships with. And the second is, they're seeing quite a bit of cancellation coming from department stores. If you look at past events that led to increased inventory levels, 2008 and otherwise, the brands had it the worst. Department stores are a little bit different. I think we may see some bankruptcies there. And there may actually be some surprises in there as well. They're order book driven, which means that their orders are placed far in advance. There I think we'll also see some significant margin pressure as they look to clear through their heavy spring inventory that's sitting in stores currently. And even with order cancellations, the competitive environment will translate into a high level of promotional pricing and severe margin pressure for some time to come. The one part I would say of the ecosystem that, is there to gain from all this is off-price. Off-price buys more opportunistically with short lead times, and, the buying levels can be managed, pretty much in real time. These types of environments create incredible buying opportunities to fuel growth. In terms of the speed, one of the things we do at Intern is make things, quick and easy. We've seen over the last months, purchase time frame cut by a third. And, just thinking of buying opportunities, remember the growth for the off-price sector, post 2008 in the financial crisis. And, I think you saw some really, really positive, strong growth figures coming out of the off-price, circuit.
Yes, no, I'd agree with that. Off-price is pretty nicely positioned coming out of this, though in the interim, as their stores stay closed and they really don't have a digital presence, they're suffering the most right now. But on the flip side, if you move over to CPG, they're experiencing a spike in demand for essentials. How do we see this impacting the brands approaching inventory moving forward? And perhaps I'll turn that to EJ to answer that and what he's seeing on the CPG side.
Thank you. Yeah, when we look at the essentials and just to give it an order of magnitude, I was working with a very large supplier of paper towels, toilet paper, and cups and occasion wear, and they've seen into Costco an increase of 10x their demand. So they've seen this huge influx that they know will not continue. At some point, there's going to be a decrease back to normalcy, but it's caused just enormous stress on some of the supply chain and the ability to deliver on it. As we look at essentials in terms of brands and how some of the behavioral changes coming out of post-COVID, I think still provides a great deal of uncertainty even for essential manufacturers. Because when we think about some of the life experiences that we're all going through as consumers and understanding how it may shape our buying behaviors and how brands need to respond to that is going to vary pretty significantly, whether you're a Gen X, millennial, or a Gen Z consumer. And brands are really trying to identify what are some of the likely changes in demand patterns, and then build some of those scenario planning, as Arnold mentioned, into the analysis, so that they can come out of some of the post-COVID planning with a totally different demand plan. And it's very clear that companies that have invested in strong e-commerce capabilities, as well as other consumer-based connections, and are focused around consumer experiences and understanding consumer needs, they're in the best health to best understand how these consumer behaviors post-COVID are going to impact the demand curve. Also, certainly companies that have a purpose-centered culture, have strong leadership teams, and have invested in platforms or ecosystems, as Arnold was mentioning, will give the agility to respond, because at a certain point you can't plan for some of these uncertainties. That there's going to be your ability to respond and have the agility to respond is going to be more important than your ability to anticipate the behavioral changes. But we absolutely expect long-lasting changes in the channel, long-lasting changes in consumer behavior, and looking at the different buying demographics. We would expect that the new normal or next normal will be very different based upon which generation you come from and where you are in your life. So it's going to be a period of uncertainty, and we are seeing that many leaders in CPG are looking at their recent investments in digital technologies in trying to determine, and in many cases doubling down on advancing their digital investments, so that they could see in a post-crisis world some excellent opportunities to satisfy consumers in ways that their competitors can't.
That makes sense. It's interesting you say that, because you can clearly see a bifurcation between the fashion and the staple companies. And, for us, a lot of our clients have asked about liquidity, right? So coming out of this crisis, who will be able to survive it? And we've done some work on our end where we've put in different scenarios and looked at hopeful versus worst case scenarios. And what we found is that a lot of these companies have enough cash as they've drawn down on their revolvers to sustain operating losses for this year. But perhaps, Arnold, if you can talk about what you're seeing in liquidity in terms of what's on top of organizations' mind as they navigate through the COVID-19 landscape. What would you say these organizations are doing or would need to do to really avoid a crisis?
Yeah. At a high level, there really needs to be sort of a paradigm shift in the approach, which historically has been purely preserving liquidity, and shifting that approach to how do I manage resources to maintain operations continuity. So, for example, previously, when companies have looked at accounts payable, for example, it's been about how do I pay my suppliers slowly, and how do I increase my days payable outstanding? And really that mindset needs to shift to what are my critical suppliers, who are my strategic partners that are paramount to my success, and can I take a balanced, segmented approach to optimizing, the balancing act between cash and supplier financial stability. I would say the same thing on inventories. Historically, it's been, look, inventory's bad. I want to reduce my finished product inventory. I want to reduce my component inventory, material inventory. But now the shift really needs to be around get what you need while you can, and let's convert it to the highest or best use and be real creative about it. I think more tactically, there's a number of things that consumer companies can do to ensure healthy cash conversion on a sustained basis. I think the first thing is really about taking a segmented approach, because let's say you have products that are in high demand. Demand has skyrocketed, but you have a supply chain, a value chain that is weak. It's not able to fulfill the needs that you have. That's where instead of increasing payment terms, you may reduce payment terms with suppliers so that you get priority on supplier product allocation. You might go after new suppliers to ensure supply stability. But on the other hand, this is where you can optimize, where you have products, let's say they're non-essentials in your assortment, the demand has reduced, you have a good supply chain to meet that reduced demand. That's where you can take the opposite approach of offloading the pressure to suppliers, extending the payment terms, freezing the orders from suppliers. You can do a multitude of things on inventory. So I think taking that segmented approach is very critical as opposed to a one-size-fits-all approach. The other thing is about how do you actually team within your organization for effective cash conversion. And our recommendation is it's really not just a finance-led kind of team. It's the finance team and having a finance-led liquidity response team coupled with and integrating with a supply chain team. And together, you're collaboratively setting the accounts receivable policies, inventory policies, payables policies on the accounts receivable with the commercial organization as well. You're providing full transparency on the current state, and you're mobilizing against that. And you're utilizing a virtual war room to go ahead and ensure you have healthy cash week on week, making sure you have that capability in place so that in the next crisis hits, you basically just turn it on. I think the third thing is really a question mark of, what are the priorities? What are the actions or what are the initiatives that you take when it comes to DSO, DPO, and inventory days? And some of the actions can include, taking a segmented approach to, days payable extensions where it's appropriate. Secondly, maybe proactively managing inventory targets, adjusting my service levels up and down to drive, inventory at the right level to meet my demand, changing how often I produce in my manufacturing plants, which dictates the amount of inventory you hold. But I think there's another key lever that's not always used today, but it will be more important, is the concept of substitutes and really optimizing the substitutes of not only your finished product, but the raw materials as well, so that you can quickly substitute something in for another product that you're short of. And that way you can better balance supply and demand. And I think the last thing, and this goes back to Ronan and Intern, it's the concept of effectively dispositioning excess stock and really around how do you go through it? How do you go through that process without having significant margin degradation and write-offs? And that's going to be critical, especially as we talk luxury goods and apparel, as EJ mentioned as well. And I think companies can apply this approach post-COVID world. The way they do that is building transparency in their inventory levels across the supply chain, across supplier payables, across customer receivables, and then leveraging that data to make decisions on improving the cash conversion, but more importantly, understanding the trade-offs with other metrics like cost. Hey, what if I reduce my inventory? How does it impact service? How does it impact cost, and vice versa? And I would say that in a future crisis, if you have visibility to that data and to make those trade-offs, and you have the processes, the routines, the decision rights, the governance in place, you can make very, very fast, quick decisions and have favorable cash positions, not only for the short term, Poonam, as you mentioned, but also for a sustainable amount of time.
Great, thank you. And Ronnie, would you like to add to that, given that you help with the largest part, of the retailer's liquidity management or working capital management inventory?
Yeah, I would just add that it's, just incredible in today's day and age that some of the largest companies in the world have limited visibility into underperforming inventory. And the result of that is there's just fire drills to sell off inventory and free up cash. The team is disrupted and scrambles, and ultimately sales are conducted at deep discounted prices. Typically when we engage with organizations, first thing we do is a deep dive into what status quo looks like, and it's absolutely remarkable. So I couldn't agree with Arnold more.
Great, thank you. So all of you have touched on the fact that, we're in a crisis, obviously, and we'll come out of it at some point, and stronger companies that are investing for the future will do better. But when we look back and we think about just consumer habits, and if we look back to the past recession, consumer habits changed quite a lot. And if I could just turn this back to you, EJ, how do you think consumer habits are changing for both retailers and customers as they deal with COVID? And do you see these lasting post-COVID, and what does that mean for shopping and for buying and just retailers and how they manage their stores and digital platforms?
Sure, and I'm glad that you mentioned that consumer behaviors have been radically changing prior to COVID-19. So really, when you look at the disruptions we're talking about, this is on top of an industry, quite honestly, it's gone through more change in the past 3 years than we've seen in the past 50. So when we look at, consumers have been pivoting towards wanting we call them just for me consumers, in terms of they want personalized outcomes, they want personalized experiences, they want brands to mean something different than what they have previously. And also, since you have the ability you're carrying around in your pocket or on your phone, you want to be able to buy what you want, where you want it, the way you want it, anytime you want it. So these consumer behaviors have really been shifting and changing, and you could see it in the marketplace with so many digital native companies. Companies like a Halo Top that became in North America the largest pint-sized ice cream, in really defeating highly capitalized companies like a Nestle, Unilever, to win that position, or Impossible, in terms of Impossible Burgers, that these are really startups, and they're attaching to the shifting consumer behavior. So now when we look at post-COVID, as I mentioned, the consumer behaviors are going to shift differently depending upon Gen X, or Gen Z, or millennials. But I think it's very, very likely that the physical distancing and the focus on health, wellness, is going to have dramatic effects on the products that consumers decide to do business with, and the level of investment and direction that the consumers will go with brands. It also is very likely to have a lasting impact on data and data privacy. Are consumers willing to give up some of their data privacy to get a better health benefit, or to get a more collective benefit? And also, I think when we look at this has had such a dramatic financial effect on families across the globe. How will this change their spending versus buying behaviors in the near term? And as well as views on sustainability, because also sustainability is closely linked into this whole topic. And companies and consumers are looking at wanting to consume more sustainable products, more lasting and wholesome type products. So I think that if you step back and you look at it, the impact on consumer behavior, you'll find a wide variety of current opinion of how it's going to change. One thing that you will find uniform agreement on, it will be substantially different in a couple months than it was 3 months ago. And something that Arnold said, I think, can't be stressed enough is when we look at the transparency of data, the ability to do scenario planning and analytics, there's still a lot of consumer products companies, whether it be in fashion, food, beverage, that don't have a technical infrastructure and landscapes and platforms to be able to have that transparency of data across the enterprise to be in a more collaborative decision making around these critical decisions, such as consumer demand.
Great, thank you. So just continuing on that data topic, data agility and visibility are at the forefront of the business community conversations. However, what kinds of data and how should companies be looking at this approach? Where do you think companies are on the data mining process? And maybe Arnold, since you talked about it earlier, if you can help us better understand where companies are and how they should be looking at just interpreting and analyzing data.
Sure. In terms of approach, and as I mentioned before, the approach to data should be beyond, and EJ just talked about it right now, beyond just the data visibility aspect. It should also have the simulation, the utilizing of artificial intelligence for advanced scenario planning, applying digital twin technologies and so on, so that you can make optimal decisions, which is the output you want to get to. With that said, from a CPG manufacturer and a retailer perspective, it really comes down to sharing data between the two. And that's where it becomes even more so important, with the objective of together between a retailer and a CPG answering the question around how do I ensure supply, how do I meet service level expectations for the end consumer, and how do I do that at a controlled cost across the end-to-end system, not just in a siloed supply chain where CPGs are looking at things separately and retailers are looking at things separately, but now how do we do it together in an end-to-end ecosystems? And I think this also means that retailers, just getting more tactically, would be sharing real-time point of sale and also inventory levels by location, by store, by distribution center to the CPG. Imagine a world like that. Or the CPG manufacturer providing real-time supply signals of where the inventory is in the value chain to the retailers. And that way together they can look at the full visibility of where the inventory is in the end-to-end ecosystem, where the products are, where's the risk to meet demand, and also collaboratively getting together what actions they can take to go ahead and mitigate any future risks, like substitution or increasing capacity. And I think just to summarize, the overall theme here is it's the data visibility and it's the analytics behind it, but it's also looking at things outside of your own silo. It's now bridging the gap between the retailer, the manufacturer, and the suppliers, sharing the information across the system, doing it in a very integrated, collaborative way, and then together you're able to meet the consumer needs at speed, but also at a controlled delivered cost where your cost to serve doesn't get out of whack.
Thanks, Arnold. Ronan, perhaps you can add a little bit more insight here, especially in off-price with inventory visibility. That seems to have lagged for quite some time. And how do you think that will change post-COVID? Will it improve, do you think, or do you think they'll still be, working through where they don't really know given how fast inventory moves through the system?
Yeah, we've seen a surge in interest, in our platform over the, last days, weeks. I think sometimes innovation is driven out of necessity. I think these are one of those moments where companies sit back and realize, hey, you know what? We haven't really stress tested our infrastructure in our approach. And, unfortunately, there's a lot of companies that are just teetering at this point. So certainly, from our perspective, we expect and we're seeing it. Companies really look to innovate, think outside the box, leverage data, but more importantly, have an actionable tool set that allows them to go next step and actually, enable just very efficient go-to-market to alleviate any challenges that they have very quickly and easily.
Great, thank you. And then I'm going to open the floor up to all of you for just a question on the recovery here. Post-COVID, how do you think the recovery will be, and speak to it by subsector, luxury, fashion, off-price staples, or in aggregate? Do you think it'll be a V-shaped recovery, a U-shaped recovery, or a very gradual recovery? Why don't we start with EJ?
Boy, that's a loaded question.
It is.
I think it's going to vary. It'll certainly vary by segment, as you pointed out, but I think it's also going to vary quite a bit geographically. I certainly would believe that luxury and fashion is going to be the slowest to return and to come back. And I think there's a lot of consumer behavioral issues more than anything. I think that you're going to see, the staples, the food and beverage, going through a period of restating their supply chain once we get back to a little bit more stability, because they have to remove some of the noise that's been generated in the system along the way. And I think, frankly, it may be a large buying opportunity for large CPG companies looking at, because we've had an absolute explosion in the industry over the past 5 years of mid-size food, beverage, durables, health, personal care companies that may struggle from a financial viability or may have very attractive prices so I think we may go through a period of merger and acquisition in kind of that fast-moving consumer goods side of the house. I see, honestly, the fashion and luxury segment having kind of the longest tail versus being a quick V. And the CEO of Phil Van Heusen put it well that when you look at brick and mortar retail for fashion and luxury has been declining, and you look at the COVID is just accelerating that to more omni-channel and e-commerce based engagement. So I think that's part of the mix for a lot of the fashion and luxury segment.
Thank you. And Arnold, how about yourself?
Yeah, I think it's difficult to answer the question or know for certain if the recovery is gonna be a U shape, an L shape, or a V shape. One thing we do know for certain is that there is a whole lot of uncertainty heading into this and how long the crisis. I mean, the way I think about uncertainty, just to maybe like double click on the question, is there's uncertainty on which the question was based on the projection of the pandemic. And there's a lot of views on the duration, the span of the pandemic, and that could be debatable. There's also the macroeconomic outlook, the volatility in the markets and how governments are responding, depending on if you're talking U.S. versus, Italy versus China, et cetera. There's uncertainty on the actual demand volatility, the demand pattern. The purchase patterns by consumers, they're rapidly shifting. I mentioned earlier about the packaged food and the frozen food and the toys, and there's every week it's changing. There's a lot of volatility and unpredictability around that. And then there's also supply instability with commodity price fluctuations and concerns over like the stability of the labor force. And I think that's the way you kind of have to view this question. In terms of projections, one thing we do know is that e-com is up, and there's a question mark around, will that be the future for some of the manufacturers who traditionally, sold through retail or through retail.com channels, but not going direct? And will there be a shift in that channel where CPG manufacturers now have to think about that as the new norm? There's a question mark on that. And that's, going back to my earlier point around why companies, CPGs, are thinking about their distribution network now, because that is a fundamental question they need to answer, and if that holds true. And I think everything EJ said about the shifting consumer needs and the channel shifts. The question is, it was already happening. Is COVID now going to accelerate some of that so that you have to reset your value chain in the near term? And I think time will tell.
Great. And Ronan, quickly, if you could perhaps shed your insight on off-price and any other sectors that you have a view on.
Yeah, I mean, it's interesting just looking at discretionary spend. Not too long ago, everyone was saying that, folks have shifted their spend from, apparel, footwear to travel and entertainment. Clearly that's been halted. So unfortunately, many have lost their jobs and are having particularly challenges, in the financial area. Others, though, are saving money. And I think the question becomes, where do they spend it? How do they spend it? I fully agree. E-commerce, is kind of the next phase, and I think, we'll see that accelerate, a lot more than we have in the past. We already are. I think ultimately the question is, will consumers go through revenge spending? If you look at, CPG, purchases spiked. Now they're down to pre-COVID-19 levels. I think otherwise, if you look at, discounted, goods in the market, and if you look at off-price, that's primarily brick and mortar in the U.S. The question becomes, does that become more of an e-commerce play, than it has perhaps in the past, similar to what we see in Europe and Asia with some of the key players there. I think ultimately the challenge, as we've said, all of us have said before, is there's a real digital readiness issue across the board, and now's the time for companies to really, beef up their capabilities, to enable continuity going forward.
Agreed. So I think that brings us to our hour. I'd like to thank Ronan, EJ, and Arnold for providing their insights, and to all of you for joining. Have a great rest of the week and stay safe, everyone. Thank you.